All right, today we're just going to talk about some of the original investing commentary and top articles that we wrote and highlighted on Validea's Guru Investor blog for the week of March 5th, 2021. And to start, Jack, we had two podcasts this week. We did one with you and I. That was kind of a new format. And then we also released our interview with John Montgomery, founder and CIO of Bridgeway, which was a really fun and enlightening discussion. So do you want to kind of talk a little bit more about what we highlighted in both of those?
Yeah, so the first one was a new thing we're trying to do on the podcast where we talk about some of our favorite academic research, and we try to, academic research can sometimes be tough to decipher for investors, so we try to break it down in terms investors can understand. And, in this case, we're talking about a paper called Replicating Anomalies by Zhang and a couple other authors. And the idea is they took, if you look at all the investing factors that are out there, or anomalies as they call them in academic research, I think they found 450 or some of them or so of anomalies that are out there that people have said, this produces a positive return. So going long the best stocks according to the anomaly and going short the worst stocks produces a positive return. But one of the things that happens is a lot of the times when academics write papers, they include the entire investable universe. And so they'll include big stocks, but they'll also include microcaps, which many investors can't invest in. And so what they did is they said, all right, if we limit the effect of these microcaps, how many of these 450 anomalies still hold? And what they found is many of them don't. So we talked in the podcast about all of the different ones, and some of the things, some like momentum held up pretty well, and other ones like some friction effects did not hold up well. But the overall idea was a lot of the benefits of these anomalies can occur in microcap stocks. So if you're an investor that follows these anomalies, you have to be careful about understanding, what types of stocks do I invest in, and then what types of stocks were actually in the academic research, because that can cause sort of a mismatch. And then the second podcast was we did an interview with John Montgomery, the founder of Bridgeway, and they're a really interesting company because most Wall Street firms are known for prioritizing profits basically at all costs. And they're essentially the exact opposite of that. They give 50% of their profits to charity. They have caps on how much their executives can make relative to their lower level employees. And they also make everyone who works there a partner. We were used the word employee to refer to the people that work there in the podcast, and he corrected us because they don't even use the word employee. So I think their unique structure is really interesting, but also we talked to him. He's been running quant portfolios now for 20 plus years. So we talked to him about some lessons from that. We talked about all the individual factors. We talked about what he thinks about value underperforming. So I think overall it was a really interesting interview. What was your article you wrote this week?
So yeah, I wrote an article on Bitcoin, which probably, it's funny, I had a subscriber guy that I've been going back and forth with. He's like, your article's going to call the top in Bitcoin, which you might be right. And, who knows? But I was kind of talking about how, if you look at certain things happening with cryptocurrencies, Bitcoin specifically, it's sort of like growing up, it's maturing to some extent as an asset. And I just tried to weave together some things with more institutional adoption from, major university endowments to insurance companies buying Bitcoin to BNY Mellon now, basically, which is a very large custodian. They're planning on holding and transferring and issuing Bitcoin and acting as a custodian for asset managers and fund managers on the platform. And, I kind of have some theories in the sense that if the asset is maturing, and there's more investors buying Bitcoin, both individual and institutional, maybe it means that the susceptibility of these massive crashes, something like 80 or 90% decline that we've seen historically, maybe those we'll see less and less of those. And then I just kind of talked about like some important maybe maturity tests that will come for Bitcoin, which will be, if when the market pulls back, we go into the next bear market, if somehow Bitcoin manages to do better than stocks or lose a lot less, then maybe that would be an interesting thing for Bitcoin. Or if we go into, a period of prolonged inflation and Bitcoin actually holds up, that would support one of the arguments for Bitcoin, which is, that it's a protection against sort of inflation and the more printing of money and stuff like that. So anyways, that was my article on Bitcoin. I like to think about this and talk about it, but I think, investors should just make sure they're educating themselves around sort of this, because it is something that's, new and people are interested in it. So.
Yeah, there was a podcast. Jim O'Shaughnessy went on the Pomp podcast a long time ago, and what was interesting, they were talking about Bitcoin, and what was interesting to me is Jim spent most of that interview saying, "I don't know," and I think that's probably the take. A lot of us. I mean, you've researched it a lot more than I have. That's the take I take myself on Bitcoin. Is I just don't. It's a very complicated topic. I'm not educated enough to know about it, and so I really don't have an opinion. Whether it's going to 1 million or it's going to 0. I don't really have an opinion either way, and I think, for people who like you who are researching it, that's the way to go about it. But it's also important for people like me who are not to say, I don't have to have an opinion about everything. I can have no opinion about Bitcoin. And that's sort of the way I look at it.
Absolutely. Yep. Totally. What was the article that you found most interesting this week on the blog?
We had an article about, the title was ARK CEO Cathie Wood Talks Deep Value. And well, first of all, that's an interesting oxymoron to say our, CEO Cathie Wood talks deep value, because they're associated with the exact opposite end of the spectrum, from deep value. But she actually considers what she's doing deep value. And we've talked about this before, but, for those of us that are actual systematic value investors, we like to say, something is deep value when it's cheap relative to its book value or its earnings or its cash flows or something like that. But there's another way to look at value, which is value relative to some sort of massive future potential. And that's basically the way she defines deep value. And so she's saying these stocks I'm looking at are actually cheap when you consider, over the next 20 years, what they might be able to do. So that was one thing I thought was interesting, is that, whether she ends up being right or not, she's redefining deep value in a different way that I've never seen it defined before. But the other thing is ARK's going to be all over the headlines right now, because they have, one of the things they do is they're very focused funds, and they've taken tons and tons of assets in. And so the result of that is they end up owning a huge percentage of the daily dollar volume in a lot of these names they have. And so as tech is sort of pulling back right now, and as tech pulls back, people wonder whether there's going to be a systemic issue here for the markets, because all of ARK's holdings are public. And as an ETF, when people redeem, they're just going to sell their shares, sort of at the weights. And so if their investors don't stick with them, and we get a significant pullback, and you have the stocks pulling back, and then you have their investors redeeming, you can end up with this cascade type effect, where as their investors redeem, ARK has to sell a ton of the stocks, and then more of their investors redeem, and then they have to sell more of the stocks. And so when you have a situation, and then obviously other hedge funds and everybody out there, given that their holdings are public, are going to try to take advantage of that if they can. So it's just interesting. I mean, I don't have a strong opinion on how it's going to play out, but it's an interesting risk out there, because we've never seen anything like this in terms of a firm that has this large of a position and also has all their holdings out there publicly. And so it'll be interesting to see how that whole thing plays out, if we do get a significant correction in tech here.
By the way, I'm really glad you brought this one up, because Ben Johnson, who is a director of research at Morningstar, just wrote an article yesterday, No Room on the ARK. And in it, he talks about a lot of this, but there's so it's really about these capacity constraints. And there's a table in the article, and it shows like all these, what are probably mid-size. They're not like really large cap tech. It's more like mid-size. And it looks at how many days it would take for ARK to liquidate these holdings at a 25% of their average daily volume. And so you have some companies where it would take 40, 64, 62 days, like LendingTree, for example. It would take them 30 days if they were selling and trying to only hit 25% of the average volume each day. It would take them 30 days for them to get out of that position. So it's just really telling that, that if things go the wrong way here, I mean, some of these companies and stock prices could certainly be negatively impacted.
Yeah, and the key here is they don't, unlike a mutual fund, where when a mutual fund gets redemptions, they have a lot of discretion in terms of what they're going to sell to meet those redemptions. When you talk about 30 days, ARK's not going to have necessarily the discretion, if things go south, to say, all right, I want to liquidate this over 30 days. I mean, their investors may force their hand by liquidating the ETF and make them have to liquidate it a lot faster. And so the question is, what would be the impact on the prices of these stocks if that were to happen? And if ARK were representing 50% of the daily dollar volume trying to sell or something like that, what would this mean for those companies? And I don't have the answer, but it's an interesting risk that's out there right now. What was your article this week?
Yeah, so it was an article from Jason Zhang, who is someone that we follow very closely, and is in his Intelligent Investor column, and the title of the article was Every Warren Buffett Needs a Charlie Munger. And he basically it's an article about why maybe you should, instead of listening to people you agree with, maybe you should listen to people that, have differing opinions than you do. And he sort of sets up the article by talking about how what's going on right now in the market, especially with all these retail investors, is they're sort of like socializing their investment experience. And it's sort of like everyone is, basically in agreement with each other. And it kind of plays into like maybe some of these stocks and these SPACs and, companies trading at 100 times sales or whatever. But a lot of it is, these, online on these social platforms, or maybe even on some of these brokerage firms, you can do like copycat portfolios where you can just auto copy what other people are trading. And so there's a lot less like research going on, and it's more just like this social investing concept. And then he sort of pivots and says, rather than that, maybe you should be doing what Buffett does, which Buffett and Munger basically, I guess Munger shoots down a lot of Buffett's ideas. And I just thought this was funny. Like when Warren Buffett likes to call Charlie Munger the abominable no man, basically for his tendency to shoot down ideas. So that's what Zhang's talking about. And then actually he ends the article. I don't know if you know this, Jack, but AAII recently eliminated their in-person, obviously no in-person meetings are happening right now, but they basically sunsetted their local chapters. So they had 34 chapters around the country that used to hold these monthly meetings pre-pandemic. And we've actually presented at many of these chapters. Our partner, John Reese, and sort of Zhang is just sort of, the fact that they're shutting these down, these were good meetings where people could share ideas and you could get differing of opinions. So he was sort of saddened to see that they did that, but I guess it's a sign of the times, I guess.
Yeah. One of the interesting things about this is going to be, when you sort of are trying to surround yourself with people who disagree with you and you're trying to have a diverse group of thinkers, how does that play out online versus how it plays out in person? Is it, and he's sort of alluding to this, is it better if you're all able to sit down in a room and sort of voice your opinions, or, what happens when that happens on Zoom, or what happens when you're following, people on social media and you're using that as your method to get opposite opinions of your own? Is it as good? Is it as high quality? And maybe it's not. I think that's something that's interesting for all of us to think about.
All right, guys, thanks for watching this episode, and we'll see you next week.
Thank you.
If you'd like to keep up on the research, writing, and curation we're doing at Validea, please go to blog.validea.com to learn more and stay updated. You can follow Jack on Twitter at @PracticalQuant, and follow me on Twitter at JJCarbonneau. Thanks so much.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.